Hello guys, welcome back to my YouTube channel. It's your girl on the board again. It's your girl Ako Yvette in the building. So in today's videos guys, we are going to be looking at the relationship between a banker and a balance sheet. Now we are going to look at what relationship a banker has with the balance sheet, or how important is the balance sheet to the banker. Okay, but before I start, I want to first of all welcome all my subbies. Thank you so much guys for always coming back to follow me up. And for those that are watching me for the very first time, please hit that subscribe button if you haven't subscribed to this channel. If you find these videos interesting, please subscribe to this channel, share the video to as many people as possible. All right, now like I said, today we are looking at the relationship a banker has with the balance sheet. Now let's look at what a balance sheet is. We look at who a banker is, and then we can now go straight into understanding that relationship that a banker has with the balance sheet. Now if you have watched my previous video, I believe you have a bit of knowledge about the balance sheet, because I'm always talking about it. Yeah, now let's go straight into the point. A balance sheet is one of the core financial statements that presents the financial position of a company. It shows the company's assets, liabilities, and owner's equity. A balance sheet is divided into two sides. The right side shows the liabilities and owner's equity, while the left side shows the assets of the company. Now, in accounting, we say it is a snapshot of the company's financial position. Without this snapshot, business owners and accountants might end up making decisions that can bring down the company. Now guys, let's go and understand. I hope you have understood what a balance sheet is. So it's just a snapshot of the company's financial position. So it shows the asset of the company, the liabilities of the company, and the owner's equities of the company. All right, so I believe you have gotten something. So let's go straight and understand who a banker is. Now, who is a banker? Who is a banker, guys? All right, so some people say a banker is anyone who works in the bank or in banking industry. Okay, so yeah, that's what people understand. But if you tell somebody like a banker is someone who works in a banking industry, people can work in a banking, someone can work in the banking industry that is not an account, that is not a banker, but is an accountant. He can work there, he's a secretary. He can work there, he's a security guard. He can work there, he's a cashier. He can work there, he's the how do I put this, the manager, the director. So you can't just say a banker is someone that works in the banking industry. People work there with different positions, occupying different positions. So I want to go detailedly so that you can really understand who a banker is. So if you meet one in any company, you should know that this person is a banker. Okay, so a banker is an employee of a financial institution who services the financial needs of clients. Now, this banker tries to maximize the profit of the bank while maintaining the appropriate risk level. Now, is that all? No, that is not all about the banker. So if somebody defines banker in that way, I don't think you really get a deep understanding of it. Now let's go deeper. Bankers are also known as retail bankers. These bankers interact with clients who are either individuals or institutions on daily basis. So if the clients here that the bankers interact with can either be individuals or institutions, all right, and they do this on daily basis. All right, now let's go deeper so you can, these 3 points will make you to really understand who a banker is. So when you see one, you should really know that this is a banker. Now this is what bankers do. They assist in setting up checking and savings accounts. Yeah, so they assist the clients in setting up checking and savings account. They authorize loans, so bankers authorize loans, and then they also counsel clients on banking products and services. So if you get into any financial institution and you see a banker or you see anyone trying to help a client to set up a checking or savings account, trying to help a client to set up an account, just know that this is a banker. Or is see one where he or she authorizes loans to be given out, know that this is a banker. And then if you see one going about in that financial institution counseling clients on banking products and services, telling them the importance of banking product, telling them about the banking services, you should know that this person is a banker. So I believe that somehow you have understood better who a banker is. So if you get into an institution, it will be easier for you to identify who a banker is. All right. So balance sheets are critical documents because they keep business owners like you and I informed about the company's financial position. Now we are getting into the relationship now. So they are trying to say here that balance sheets are very, very important. They are critical documents because they tell you and I that wants to invest in a company or that wants to give out provide services to that company. They tell us about that company's financial position. All right, just imagine that, for example, AY company comes and shows you its balance sheet. It's going to help you. You are going to know the financial position of that company because you're going to know about the assets, you're going to know about the company's liabilities, and you're going to know about the company's owner's equity. Of course, we know that if the liabilities of the companies are more than the assets of the company, it definitely means that the company is not doing well at all, which means that at the end of the day, the company might end up selling out its assets, selling up its assets to meet up with liability, and it might not still be enough, which means that company can go bankrupt also, or just fail. All right, but if the company's assets, of course, are more than company's liability, then we know that somehow the company is doing great. Now, most business owners always ignore this and fail to realize their business are in trouble until it is too late. A balance sheet is important to a banker because it makes them to know or determine if the company is qualified for additional loans or credit. If company's liabilities are more than its assets, then that company is in danger of bankruptcy, like what I just said, guys. So if, of course, a company's liabilities are more than its assets, we know that liabilities are what the company owe outsiders, and assets, in very simple terms, liabilities are what companies owe outsiders, and assets are what the company owns or outsider owes the company. All right, so now imagine that what the company owe is more than what it owns. That is not way. How will that work? It means the company can easily go bankrupt. All right, now, so if investors appreciate when they investors appreciate when they see a company's balance sheet because they know exactly where their funds are going to. All right, so from what we just said, we are trying to say that it is very, very important for bankers to know the balance sheet of a company. If they are dealing with a particular company, or if that company is coming to them for additional loans, or if they have given a loan to that company before and expecting their money, it is very, very important for a banker to know. All right, because remember that a banker authorizes loans. A banker authorizes loans to be given out, which means that when that bank comes, when that company comes, to the banker will be the one to say, okay, go ahead and get the loan, or go ahead and tell the loan officer, go ahead and grant them loan. All right, so that is why the banker needs to know the balance sheet of the company, because like we said, the balance sheet of the company shows the financial position of that company. So it will show whether this company will be able to pay back these loans they are going to take. So the banker cannot accept for loans to be given out to a company that its liabilities are more than its assets. It's not possible, because they know that at the end of the day, they will not pay that money. They are owing outsiders. Imagine the company owning or having 5 million as its assets, and then it's owing 15 million as liability. Do you think that company will go bankrupt, and they will not be able to pay that debt, that the loan they are to take? So that is why it is very, very important for the a banker to know the balance sheet of the company it is dealing with or wants to give out loans to. All right, because they know that if they do give out this loan, they might end up experiencing credit risks. All right, credit risk is a risk of default of payment, which means that a customer comes get a loan and did not pay. That is what we call credit risk. All right, so that is why it is very important for the banker to know the balance sheet of a company. Okay guys, so that is just it about the relationship between a banker and a balance sheet. Thank you so much for watching. Don't forget to subscribe and state a comment at the comment section.